Really love to hear your thoughts on perceptions of time. Because from one perspective, buying coffee mugs for 20% more doesn't make any sense from a short-term perspective. But my hunch is that you have a much longer-term perspective in which that does make a lot of sense. And to pick up on Joe Nocera's point, yes, your situation in terms of being the founder of Starbucks is very unique, but if you look at the other end of the spectrum, Paul Pullman at Unilever doesn't report quarterly earnings anymore, and he's announced publicly that he doesn't want to take hedge fund money. So you've got two CEOs in very different situations doing somewhat similar things. So I'd be curious very much to hear your thoughts.
I mentioned earlier, we've been a public company for 20 years. And during that time, the most significant change in running a public company is the unbelievable short-term mentality of Wall Street institutions and financial investors. And let me put it in perspective. I think when we went public 20 years ago, I have a good friend of mine, Dave Fuente, in the front who was the CEO of Office Depot. We've talked many times about this. Maybe 3, 4, 5 months max was the mentality in terms of quarter to quarter. I don't think it would be an exaggeration to say, literally, we're talking 5 minutes now. And what I mean by that, if I issued a press release tomorrow that there was any indication of a slowdown or something was wrong in any part of our business, our stock would drop 10%, 5%. And I'd have 100 phone calls, I'd have the media, and all of a sudden, the bloom is off the rose and the story would begin. And we have to manage through that lens because it's real, and we have a responsibility to shareholders. Now, not like any other constituency, you have to try and build trust and confidence with that group. And it goes back to what I said earlier about performance. I think there are companies, there are public CEOs who are given that license based on years of relationships, confidence, and performance. But the truth of the matter is that 90% of public companies today are held under a microscope that is a short-term mentality that is extraordinarily difficult to navigate against. And I think that's why you'll see less companies going public and some public companies going private. I have a very good friend, the CEO of Procter & Gamble, a fantastic CEO, Bob McDonald, world class. And they're killing him because he's fighting against the headwinds of Europe. Well, Europe is underwater. He can't sell more soap. and they're destroying the guy. I mean, it's unbelievable. It's unfair. So I don't have an answer for you, just describing the landscape, which is very, very difficult. And that's why you need board members to support the CEO's long-term strategy and stand up to the short-term mentality when the stock goes down.
Christy Hefner, and I'm told I was the longest-serving female CEO of a public company ever. But I want to build on the point you just made, Howard, because if we're going to redefine shareholder value, who our shareholders are is a critical ingredient. So I wonder what you think about potential changes in the systems, such as requiring a period of time of holding the stock to have the same vote. Are there things we could do structurally that would help to bring about a better alignment for long-term shareholder value creation?
Christy, I think that would be more difficult than getting campaign finance reform. But maybe the two of us can try and do both. I think Wall Street would reject that, has rejected that. And not only do we have traditional holders, we now have day traders that are using algorithms and computer programs in which traders are trading within seconds. And that's why the mentality of the street is so different today. You don't know who's holding the stock. You don't know the momentum of the stock and how it's being treated. And it's hard to even pinpoint the cause and the effect of the stock going up or down sometimes. So great idea, but extraordinarily difficult to do.
Howard, let me ask very quickly. If you said in a previous answer that you have a responsibility to shareholders. But you've also said, maximizing profitability is not or should not be at this point in time the ultimate goal of a corporation, that it has a series of goals that it has to manage. What then is the responsibility to shareholders? What is it?
Well, the responsibility to shareholders is to create value for them, to do it in an honest, transparent way, and not to do it in a way that would be inconsistent with the values of the company. Now, when a shareholder buys a share of stock in a company, they have done some homework and they understand what the growth rate is, they understand what the guidance is, and they understand what the company has said about its other responsibilities. So there shouldn't be any surprises. But let me rephrase something so there's no misunderstanding. I do not believe that any company, including Starbucks, should sacrifice profitability for social responsibility. I believe we have to do both. And I think the attempt that we've tried to do over the years, not always perfectly, is to do both. But if we can't make a profit due to a social issue or an endeavor, then we're not going to be able to do that. The question is, how do we do both?